Okay, welcome back from lunch. We do apologize for the slight delay as we were dealing with a technical glitch. We will now kick off the second half of today's event with a focus on alternative investment strategies. In this segment, we will be joined by Deborah Ng, MD of Alban Partners, Chu Ing Kwong, Group Head of Portfolio Solutions at Nikko AM, Rainer Michael Price, who is Partner and Portfolio Strategist at Das Family Office. Moderating this session is Jay Mohey, Head of Origination at Maybank Prime Brokerage. Jay, may I invite you and your participants onto the stage, please?
Good afternoon. Good afternoon, everyone. Welcome back from lunch. This is the post-lunch food coma session. So my job is not just to keep you all awake, but also try and navigate together through this macroeconomic and asset allocation environment that we're being presented with this year. So look, we have a post-pandemic environment. We have a pretty big battle against inflation going on, and we have this increasing rift between the US and China. So the idea of this panel is to try and get a perspective from different parts of the allocation universe. We've got a very diverse and very experienced bunch of people here, seated here, who can kind of talk us through the opportunities and challenges that lie in front of us. I'm going to save a bit of time by not having you guys self-introduce yourself, so I'm just going to kind of go straight into it. But if you don't mind having a little bit of an introduction for the first question, right? Look, we're halfway through 2023 now. I don't see any masks, so it's all good. People are partying. So I just want to get a feeling from you, very broad in terms of your perspective on asset allocation across different asset classes. Where is the smart money going? What are your thoughts, right? Can I start with Deborah? You play the role of gatekeeper to very large institutional investors that invest mostly in hedge funds. Can I start with you, Deborah?
Thank you, Jay. And thank you, Maybank, for inviting me to participate in this panel alongside Wing Kwong and Michael. So look forward to sharing our views. Alban Partners, for those who don't know, is a specialist global advisor on alternatives. We work for over 300 of the most sophisticated LPs globally, and they have over 700 billion invested in PE/VC, private debt, infra, real estate, and of course, liquid alternatives. So that's, I think, the reason I'm here today, to kind of share what we see from that perspective. So to Jay's question with regards to asset allocation, the bigger picture and taking a step back, what's changed in the post-pandemic world? I think at the, I think it was 2021, and just as a reflection of what's changed, from allocators' point of view, Future Fund put out their first paper, and it was called A New Investment Order. This is September 2021. And they're really describing the differences of the situation now versus the 30 years prior, right? And they followed that up with a paper called The Death of Traditional Portfolio Construction in December last year. And really just reflecting on how the world has changed, and therefore how asset allocation must change for allocators globally. And just very, some key contrasts of how the present world differs from the past. The past, we had 30 years of globalization since the fall of the Berlin Wall. We've seen that a lot, quite different right now. 20 to 30 years of remarkable Chinese growth. We've seen that growth slowing. We've had 4 decades of post-Volcker interest rate declines. We know where interest rates are going or have been going. an abundance of energy and food. Clearly, we're seeing a lot of stresses as a result of the conflict in Ukraine. And a 30-year peace dividend, obviously, again, related to Ukraine, and a 30-year access of global labor and capital mobility. So these are very important points and important changes that we all acknowledge. But as a result, I think, allocators like Future Fund, allocators like our own GIC, allocators like New Zealand Super and CPBIB, and all these large global, very well-respected allocators are revisiting how they look at and allocate to opportunity sets.
Thank you, Deborah. Wing Kwong, you have helped manage portfolios for large institutions, including GIC. I can mention that, right? It'd be good to get your broad perspective as well on navigating the risks and opportunities at this point.
Hi, I'm Wing Kwong. Thanks for having me. I run the Global Portfolio Solutions Group at Nikko Asset Management. My group mostly works with clients to formulate and create customized solutions, investment portfolios. And in our work, I work extensively with our internal teams within Nikko, as well as external portfolio managers. I would like to start my comments by saying that post-COVID, during the first year of COVID, manufacturing was booming because people has money but nowhere to spend. But right now, we are really seeing the aftermath of that, where the manufacturing economy, especially in the US, weakening. And the ISM manufacturing numbers last printed 45.6, I think, and is clearly in the contraction territory. But thankfully, in the US, the services sectors is still holding up well. And employment is still holding up well. One reason is because companies are still holding on to their employees. I mean, there was this term called employee labor hoarding, because they know that when they let them go, they might not be able to hire them back. So, but looking forward over the next few months, the danger is really about whether companies can continue to keep their earnings high, or whether we'll go into an earnings recession. And that is really one thing that we will keep watch over. On the inflation front, we have turned more dovish in a sense that we are starting to see service inflation coming down. Of course, one of the biggest components of services inflation is owner rent. And we know that property prices have come down. It takes there's a lag of 18 months thereabout for this to be transmitted to lower services rent inflation print. But we're starting to see that. And some of the early leading indicators on rent suggest that new rent and properties are being rented at much reduced rent. So generally, we are more sanguine on the inflation front. But something to watch is really whether the US economy will go into recession. Right now, last quarter, US GDP was 1.6. And it doesn't take much to tip it into recession. So from an asset allocation perspective, I just want to follow up on one point that Deborah mentioned. We continue to have a lot of 60-40 discussions on asset allocation with our client and prospects. But the 60-40 is no longer 60 equities, 40 fixed income. It is really about 60 public, 40 privates. And within the public sphere, they're actually taking a very total return orientation. And they are less constraining and in their public market strategy constructions. And I was just having a discussion with Deborah before this that we are really starting to see the convergence of public and private together.
Yeah, can I just add a point? I think for those who know Chiam from GIC, he actually very publicly said that, we've reached a point where it's kind of the fourth realm of portfolio construction, right? So the initial was the 60-40 was a Norwegian model, equities, bonds. Then we moved towards the endowment model, where you had a higher allocation to privates. And then the third one was more the original Canadian model, where you have, more dispersed delegation, better governance, and then also just having a exposure to different assets. But today, I think the new paradigm is called a total portfolio approach, where you're looking at, solving for total returns for the portfolio as opposed to, which asset class, and breaking it out that way. So opportunities.
Yeah, I think that's very helpful, and it's a good segue into Michael. I know you come back from Switzerland and Qatar, so it would be good also to get your perspective in terms of what you're seeing.
With regards to global capital, especially private capital, there are two, like the lady was saying, two questions. I mean, store of value and purchasing power, and that really is the trillion-dollar question. Is the United States dollar still a good store of value and also a purchasing power? Because you see, I think the biggest mistake investors have made last year until recently was this idea that inflation will be temporary. And I mean, if you speak to anybody in Singapore, rent prices in Singapore do not seem to be temporarily going up. It's an inflation resetting, right? And even I think the government here said that the next Prime Minister of Singapore should be a real estate agent. That shows you that, that was publicly quoted in the local press, right? It showed you that inflation is not just an academic problem, it's a problem for everybody who is looking at wealth and portfolio construction.
Okay, I think we may come back to that a little bit later on. And by the way, we are going to have some more interaction. There's going to be some voting and stuff. So we'll have more on that a bit later. But I want to get a little bit more specific now and talk specifically about rates, interest rates, right? Big question out there is, are we plateauing? Are we going up a little bit more? I know our house view is a little bit more, and then we come to terminal rate. So two questions: where do you see rates going, and how do you benefit from this potential bonanza that you might see at the year end? Party time, everyone, equities, bonds, everything goes up. Is that going to happen? Can I start with you?
I'm not too different from market consensus in expecting one rate hike this year. But market is also pricing in a rate cut in the US, I'm talking about US rates, as early as early next year. I am probably not as bullish. I think the Fed will keep rates higher for longer. But ultimately, it boils down to where inflation is. Like what I mentioned, I'm actually more bullish that inflation will come down. But not to this. If you look at US 1 year break even right now is about 2. 5 year break even is about 2.1, 2.2. I'm probably, although I say that I do see inflation coming down, but I'm not there yet in embracing this low inflation print. So generally speaking, I would say that I'm consensus in terms of expecting 1, but I also think that the Fed won't ease as quickly as what the market is pricing in.
Michael?
I think it's a three-dimensional chessboard puzzle, if you think about it. The other key question, of course, is oil. I mean, I just came back to Singapore yesterday, and the plane did not fly electric. It was still basically an oil-driven, and basically that's another key question, right? The outlook of oil prices and also that geopolitical situation. I think it's quite telling that Mr. Blinken of the United States State Department, right? He went to Saudi Arabia first because before he met with Xi Jinping in Beijing, right? And I think that's very telling. And also from a global asset allocation point of view, that should not be underestimated. What the Chinese government has actually achieved in the Middle East is something that the British and the Americans have not been able to do over the last 40, 50 years. And that is potentially a game changer that fundamentally impacts every portfolio asset allocation decision. Because if you think about it, whether you invest in Singapore real estate or in a banana farm in Africa, it's all about the United States dollar and the external value of the dollar, right? And in this case, I think it's important to see what's going on between the Middle East and especially Saudi Arabia and China. And that is quite important with regards to even the BRIC currencies. And that, I think, is still, to some extent, not fully appreciated yet. The breakthrough we saw recently, that since 1979, the Islamic Republic of Iran has been a very difficult country to work with, or at least in the Middle Eastern context. It was Xi Jinping and the Chinese government who somehow managed to bring Iran and Saudi Arabia together, and that potentially has a major impact on global asset allocation, and also the dollar for that matter. Yes.
Thanks, Michael. Deborah, you see smart money, not just pension funds allocating to hedge funds, but hedge funds themselves, right? You see their strategies as well. What's the story? What are you seeing?
I don't think we really opine on the direction of interest rate, shall I say. I think most people, well, I was surprised that they paused at the last rate. I expect them, the Fed to continue to hike as long as they are worried about inflation. So similar to Wing Kwong, but I wouldn't, be able to kind of opine on how many before the end of the year. Our interest mostly lies in, finding opportunities and strategies that will benefit from rising interest rates and higher interest rates today, right? So that actually allows for a lot of the liquid alternative strategies to benefit. For example, CTAs who hold quite a large amount of unencumbered cash. Clearly that cash is earning a lot more than it was, a few years ago, right? So just by having that, you kind of have an uplift if you're holding 80% unencumbered cash while trading futures and options. The other element also, like for private credit strategies, some people expect those strategies to benefit because, there's a floating rate element to some of the underlying assets there. So then that's a natural, benefit for a natural uplift. And obviously on the private market side, allocators continue to try and find opportunities in inflation protection type strategies like infrastructure, some pockets of real estate. But in the infrastructure space, obviously because of the crowd of money, rushing into those inflation protection strategies, clearly the returns have also been compressed somewhat, right? So investors have also had to be a little bit more creative or redefine or look for new opportunities, be it from energy transition, be it from digitalization, or decarbonization opportunities. So there are a lot of interesting and different opportunities that can still be considered infrastructure. During the lockdown period, there was a manager that was offering to expertise to allocate to 5G spectrum. And that was a fund that I guess fell under the category of infrastructure. So you're also seeing more interesting kind of definitions of infrastructure. One thing that I think many people don't or may not realize, especially if you're not running a hedge fund, that going short now could be far more lucrative than it used to be, because when you post collateral, when you short, when you borrow a stock, again, that collateral is earning more money than it used to, right? So even that, equity long short strategies could be returning more than they used to. So, and just by volatility, I think there are more opportunities to be had as well.
Yeah, I mean, we see that as well from a prime brokerage perspective. But yeah,
no,
Michael.
just to share with you, as a private investor and as an investor in general, on the long side, time works in your favor, and on the short side, time works against you. And I think it's also important just to add to what Deborah just said that, I mean, Maybank is an ASEAN bank, and the title of this conference is Invest ASEAN, right? And I think it's important to point out that long ASEAN is becoming increasingly consensus. But then I think it's important for every investor to remember the old Wall Street saying, just because it's consensus does not make it wrong. And I think this is also, I mean, I just came back from Switzerland and the Middle East, and that is also something, a theme that is big enough and potentially long enough that people feel we can put meaningful money here, yes. In particular, from a portfolio point of view, we have seen much more interest in, for example, ASEAN or Asian real estate. And according to some data sources, among, in this case, Prickin, ASEAN real estate has outperformed both European Union and United States of America commercial real estate. And that is something where private capital is increasingly looking at. For example, if you had $200 million sitting in Geneva, where would you put it? You know?
Okay, that's useful. Come back to the geographical part of it later as well. Risk and opportunities. I know it's a bit broad, but you can be as specific as you like. I just want to get a feeling from you in terms of either yourself or your client base. What do you see as the key risk events going forward, as well as key opportunities? You can have one of each, or you can have one of neither, or whatever you want. You go for it. Deb?
Okay, so for us, we act on behalf of allocators, and our job is to make sure that the risk that you're not paid for, that the clients are aware of it before they allocate. So I would like to spend this time just talking about just the importance of operational due diligence for the managers or GPs in the room that have had to undergo an all-born due diligence. Thank you for your patience. And know that we do this on our clients' behalf. But I was just talking to Wing Kwong, because we've been in the industry for quite a long time, and I really see that the private market side is now going through what I think the hedge fund guys had to go through in 2008, right? So allocators, started back then to demand, third-party valuations, independent third-party administration, for example, and just pushing a lot of better governance and best practices. Because I think in the way that the industry actors, and it's both allocators as well as managers at that time, how they react, dictates, I think the reaction of regulators into the space, right? And there's a lot of press, that kind of vilifies, be it like hedge funds or private equity guys. In Germany, they famously called them locusts. Yeah. So it's just, and collectively as an industry, I think we really need to continue to push for that, because the fundraising environment for private markets has been or had been, so active. I think it was very hard for allocators to push back on some of the issues that they found. We see that now there has been a lot more focus from the LP side of the equation to at least have the wherewithal to ask for some of the better practices. And SVB and Credit Suisse, just highlighted the need for focus on counterparty management. I mean, for some of the smaller VCs, you are constrained as to who your counterparties are, but certainly allocators are seeking for their GPs to just think about certain risks. Similarly, the understanding of, the so-called safe assets they're looking at. Obviously, nobody expected, the violent gyrations in the valuations. But again, this is, I think, how the industry is progressing. So I think increasingly we'll see more of that and more accountability. But through the SVB situation, actually most of the GPs were very responsive. They understood the importance of transparency and communication. And now I think a lot of the LPs that we work for are looking at the kind of the underlying terms, fee offsets, how they are defined, expenses and the ability to charge those and so on. So I think currently that's kind of the risk that the allocators are trying to deal with, because when markets are difficult, then that's when I think these issues will come to the fore, right? So if everything's nice and a lot of people fundraising and lots to allocate to, then maybe not so evident. But I think under stress, all the weaknesses will show, and we're trying to help clients preempt those issues.
That's an interesting perspective. Michael, what are you hearing from the shores of Lake Geneva and nice?
To answer your question, the biggest risk I think is now geopolitical risk. And just to share with you, many people are worried about so-called AI or artificial intelligence. The more important question is, should we not be worried about human stupidity? We can see that's really the trillion-dollar question, whether it's recurring the unfortunate situation in the Ukraine or the country that is officially known as ROC, Republic of China, also known as Taiwan, right? And this is why I think it's important that this geopolitical risk needs to be addressed with hopefully better diplomacy. And I think that's really the biggest risk that hopefully can be avoided. And that's why I think it's also important, as I said, that Mr. Blinken went to Saudi Arabia first before he went to China. Also because I think what sometimes people misunderstand is that for Mr. Putin and Mr. Xi Jinping, these are highly emotional issues. It's not a spreadsheet exercise, you know? And this is where the human error risk is quite high, in my opinion. And hence it needs much better diplomacy. Because World War III is in nobody's interest. And then your portfolio then doesn't matter anyways.
Very true, very true. Inquan?
One way my team think about risks and opportunities is along the time horizon. In the short to medium term, this becomes trade for us. So for example, with US 10-year at 3.8, we have been adding to US durations. This is a trade. We continue to like long Europe risk, short US risk. But in the longer end of the horizon, I think that worth mentioning two big opportunities and risks. The first is about food and agri-technology. And that is something which, especially food securities, and the way to solve it is really through agricultural technology. And that is something that we really can think about how we can make money from it. The other is really in the area of energy transition and efficiency. It is becoming quite common for us to talk to our prospects and clients about how to decarbonize their portfolio. And this is not just about investing into EV companies or EV ETFs to catch the bounce, and it is really about how they can have a smaller carbon footprint in their portfolios. And one glaring aspect of it is really how to think about the SAA portion, how to decarbonize the SAA allocation. And this is one big area that we've been working on.
Your own money, I think the important question always to understand is when does it become hype and when does it become a bubble? But I think with regards to global asset allocation, I think this question about fixed income versus equity, increasingly, look, I mean, the country of Turkey has been in the media recently as well, but investors in Turkey have understood for a long time, not since the Ottoman Empire maybe, that equities as an inflation hedge is the way to go. And hence, basically, from global asset allocation point of view, I think you cannot be too bearish on public equity. So I think I'm still of the view that equities as an asset class might actually outperform. So equities outperform over fixed income because inflation most probably will stay higher for longer, in my opinion.
Can I just press you on that? Because I was going to ask you more about sort of cash versus bonds as well. There are people that seem to want a very, very long-term relationship with cash as opposed to having a brief flirtation with it. So is that what you are also seeing in sort of the family office circles and in wealth circles as well?
I mean, especially last year, people have understood, or rather learned the hard way, that fixed income or bonds was increasingly return-free risk, right? And of course, now the question is, can we see meaningful rate cuts? But again, I mean, I'm of the view that the Wall Street consensus view is potentially correct. That means no rate cuts, no recession. And that's really important for all asset allocation questions. I mean, are we going to have a recession in the United States of America? And are they seriously drastically going to cut rates? And this is, of course, where Saudi Arabia comes in again. And this is why it's so interesting to see the conversation that Mr. Blinken had with the MBS, Mohammed bin Salman, right, about this whole question about, is it oil that is causing inflation in the United States, among other things, right? And that is also, of course, becoming a bipartisan issue in Washington. But so from that perspective, I still think that also US equities and global equities can outperform. But within global asset allocation decisions, I think the title of this conference is increasingly is key, that long ASEAN is becoming consensus, and it's also large enough a consensus to make this trade or trend meaningful and potentially even sustainable. So long India, long Indonesia, long ASEAN, even the smaller countries, I would say.
Wing Kwong, just a little bit in terms of your response to the sort of cash versus bonds, but also equities versus bonds as well, please, because, you know, as you know, equity risk premium is at an all-time low, 2%. So you comment on both those relationships?
So my team has been too slow to put back risk this year. We ended last year very defensive, and that works well for us last year. But this year, we just have not been fast enough to put risk back. Cash is still at about 10-11% for us. Last year, it was like 20-25. But right now, with yield backing up so much and money centrifugal of the US, we are reaching closer to the terminal rate. So we are really putting back a lot of US duration in our portfolio. Equity side, I still haven't got the conviction to look through the next 6 months. So we are still trading equities from a very tactical perspective, especially managing the tactical equity exposure via shorts in Dow Jones and Russells. But we're also closing that out.
Okay. Deborah, I know there's no point talking about the cash world as far as you're concerned. So the question I have for you is, in the alternatives world, saw a lot of money going into private equity. So private equity versus hedges, the question I had for you, what's happening there?
Actually, in Asia, the Japanese were the first to allocate to hedge funds because their cash rates were so low. So actually, the hedge fund versus cash is a very good, comparison, because oftentimes a number of allocators, when interest rates were low, would allocate more to liquid alternatives, right? I think the tension that's happening now is that, say you are a pension fund or an endowment fund that has faced with the denominator effect. So say you're a university endowment fund, very high privates, and your liquid part of your portfolio has fallen and you're stuck with a lot of privates. I see allocators want to increase to alternatives, but in this case, they also want to keep some element of it liquid because they need that, because otherwise they're stuck. So I think it's quite a big tension currently. In addition to that, the hurdle rate has risen, right? So don't forget, when you invest in alternatives, there to some extent is a hurdle rate. However, having spoken to a number of managers, it doesn't sound like LPs have started asking them to increase, or it's cash plus. But then does that mean, like, if cash is 5, then you're supposed to deliver 10, right? So those are, I think, difficult questions that may not be fully dealt with. On the private equity side, I think a lot more people, and Wing Kwong mentioned that, now you're looking at 60-40, 40 being, privates, right? So in certain cases, and almost everyone's interest is aligned to have less liquid valuations, because then the GPs can keep the money longer. The allocators can commit and stay in there longer, and the returns for everyone are scrutinized less frequently. So that's just being very cynical. But, it's aligned. But, I think increasingly, if you are not over allocated to privates, then you could then take the opportunity to benefit from the so-called illiquidity premium or illiquidity opportunity set. There are statistics, though, that show that, and my very first job was an equity research analyst at DBS, and at that point in time, I think in order to liberate value creation from a company is upon IPO. So when you list, that's when you make a lot of money. I think that has changed quite a lot, which is why I think a lot more people are allocating to private equity, because companies are staying private for longer, and therefore, and depending on how many rounds you get, that's where the value creation is. By the time it comes to listing, then it could be a very different kind of economic argument. So I think that's the real driver, as opposed to liquid versus private equity, liquid strategies, because I think they serve different purposes in the portfolio, right? And in actual fact, there's probably a lot more money that goes to private equity if you're solving for all the equity allocations, potentially moving to privates.
Yeah, I mean, we've certainly seen a lot of demand both for bonds in sort of the middle range, as well as for money market funds. So Just before we get to the fun stuff a bit later on, where we're going to have some voting and interaction, just want to cover geographically. I know we've sort of touched on some of these things, but what's hot and what's not geographically? I know, Michael, you've covered a couple of things, but there's 2 points I want to specifically, if you guys could reference China, which is recording sort of a sub-expectations growth, and also your view on ASEAN. So just more of a geographical perspective on, maybe Michael, I know you've said a couple of things.
Look, I mean, global rebalancing or portfolio reallocation, I think is real. And I think this is also, I think, what the recent stock market performance from Japan has shown us. As you might recall, Japan the Japanese yen was considered to be basically a safe haven currency, and that basically has proven wrong. The yen was among the world's worst performing currencies, but now the Japanese stock market is outperforming in a major way. And this is, I think, also where you see more momentum coming in, because if you think about it, if you have to rebalance out of China, you can't necessarily invest in Laos or in Sri Lanka. You have to go to large markets. So that in particular would be Japan, and then followed by that after that would be ASEAN. ASEAN is an asset allocation call, right? And this is again the question that I think Mr. Blinken might actually give us the answer to. Can China become the new Russia? Hopefully not, but that's the trillion question. And that is also, again, as I said, I'm not worried about artificial intelligence. I'm worried about so-called human error risk. Yeah. Because that's ultimately also a political decision.
Okay, Wing-Kwong?
Many people are now finding proxy to China. I mean, after the fizzling out of the reopening trade, people still believe in the China growth, but absent a committed stimulus package from the Chinese government, I worry that people will not re-engage with China as eagerly as last time, especially now that there's this US-China tension. But what we are seeing, and all of us are doing it, that we are finding proxies to China. Just like what Michael said, Japan has been used as a proxy over the past few months. Of course, the rise in Nikkei isn't entirely due to that, because there's also a function that of a very dovish BOJ, because actually Japan probably is the only country in the world that welcomes inflation. So, but on ASEAN will always have a role, and I also echo what Prof. Tan said in the previous session, that ASEAN could potentially be a net beneficiary. But there's also a convergence theme between China and ASEAN, as in ASEAN don't just benefit from China economic recovery, but increasingly with China plus one, China plus two, we are actually seeing the internationalization or regionalizations of Chinese manufacturing industries. So that could become an interesting theme.
Okay, and Deborah, I know most hedge funds, I got a request a couple of days ago about an investor that was interested in ASEAN-focused hedge fund. So are you seeing that, or are you seeing people moving away from China-focused hedge funds?
So October last year, Texas Teachers Pension Fund, quite publicly announced a change in the way they look at the benchmarking for emerging markets, right? And they effectively ended up doing a composite with emerging markets, including China benchmark and emerging markets ex-China benchmark. And what it did was effectively reduce their benchmark allocation to China from 3% to 1.5%, right? It doesn't sound like a lot, but given the context of how large the assets are, it's still pretty significant. Plus, it was also, I think, an indicator of the thinking of not just US public pension funds, but a number of Canadian so North American pension funds. So I think that was quite significant. A week ago, the Financial Times reported that global fund managers are rushing to meet client demand for new Asian investment products that exclude China, right? As the region's largest economy is hit by slowing growth and mounting geopolitical risks. And they mentioned this term called Asian Allies Fund.
To add to that, I mean, Asia ex-Japan became a very, very well-known expression in the global, in the investment industry. Asia ex-Japan, right? But it depends on, the United States of America still has the largest military in the world, right? And it depends on, for example, whether potentially we could see Asia ex-China. But that again is beyond us, I suppose. But this is potentially a real risk that I think is still somehow underestimated.
Yeah, and I think that's what the Financial Times, they said that this had happened to Japan 30 years ago, and now there could be a possibility that actually allocators, especially emerging market allocators, are looking to kind of minimize China and Japan so that there can be more room, for allocations to markets like Vietnam, like Thailand, like Indonesia, which are very high growth, right? And that could be kind of the impetus for them trying to do this, because then they can, if you're allocating to emerging markets, but there's a large China component, I think China makes up 30% of the EM market, then you are precluded from that, political issues aside. I have some statistics if it interests people, but Goldman data shows hedge fund allocations to Chinese equities has dropped from 13% in January to 9% end of May. Investors trading Chinese debt through Bond Connect sold 31 billion worth of government bonds in the first 4 months of 2023. In contrast, according to ANZ Bank, foreign investors have snapped up nearly 38 billion worth of emerging Asia ex-China stocks and bonds this year, with net purchases of 22.4 billion in May alone, which is the largest monthly inflow since 2011. So it gives you kind of a sense of the movement, right? It could be anecdotal, it could be just May, but I do believe that it reflects, kind of a larger trend.
Thank you. That's actually very helpful. Those stats are actually very interesting. We have about 5 or 10 minutes left. What we're going to do is we're going to do a quick fire, rapid fire round. But how we're going to do it is that the panelists will do the round first. So not to say that you guys should be influenced by their views, but you will have a chance to hear from them. Okay, so guys, only 1 second, right? You cannot have a lecture every time I ask a question, right? So, so there's going to be 3 questions, and then meanwhile, if you could all get your Slidos. Yeah, you need to basically scan the back where it says slide, right? And then once you've done that, you'll be able to answer the questions as well. But okay, so let's start. Only 3 questions, so it shouldn't take very long. Rapid fire round. First one is a number you have to give me. I'll start with Deborah on terminal rates.
5.6.
One more high, upper bound at 5.5.
6% in United States dollars.
Yes, it is, yes. Thank you. Remember all that. Next one. Fun stuff. Trump, Biden, or someone else? Deborah?
I really hope it's Biden.
Someone else.
With this, I'm not a United States citizen, but I would, for the benefit of the world, I would say hopefully somebody else. Because you see, look, I mean, just for full disclosure, right? When Mr. Trump left the White House, people felt it can only get better. But then look what happened. We're close. I mean, I'm a European, right? And we're almost getting into World War III, which is very scary, you know?
Okay, let's not get too much into it, but
for somebody else, hopefully.
Okay, last question. Serious topic. War or no war over Taiwan, or maybe a limited conflict?
If it's Trump, there'll be war.
Limited conflict.
No conflict.
Okay. So
better diplomacy.
Okay, we flashed the answers here. So sorry, can you go to the first one again so we can have a look? Are you able to go back? No. About terminal rates. Okay. Interest rates globally peaked. 48% no, yes 47%, not sure 5%. And then the next one, Trump or Biden? Neither. Very interesting. Who? Ooh. Trump, DeSantis. Okay. And the last one? Is that been done properly? We got 0 for everything. Ah, there we go. Okay. No war. Okay. Limited conflict, 41%. Oh, okay. That's relatively positive. Okay. Do we have questions from the audience? Oh, sorry. Give me a second here. Okay, questions from the audience. We have only like a couple of minutes, but I'll choose one. Can you share your view on China-India relations, and will that play an impact? Any quick ones?
It's a major impact, and this is also, I think, that India as a country potentially, as a market as well, can potentially, from an investor's point of view, can potentially take over the role that China used to play for investors, that cannot afford not to invest in it, and that is also now becoming consensus. But don't forget, look, as a European, I'm again pointing out that if you look at world history, there was a time when both China and India were the most important economies in the world, and potentially we can see that again. Look, according to World Bank data and IMF data, India already has overtaken the United Kingdom as the 5th largest economy in the world now, right? And I think that trend is for real, and we will see more of that.
Okay, one quick one, probably for Wing Chun, is is there potential the U.S. currency might implode?
Probably not in my remaining career. So it will happen, and but I think it is really difficult to displace US dollars. The strength and also the importance of US dollars in the next 5-10 years. But definitely it will come. With the amount of debt the US have, I mean, that should really sound an alarm bell. And with the shift away from petrodollar, potential shift, that they will also contribute to. I think there will be a lot of factors, but probably not in the next 5 years.
A very quick question for Deborah. What are your thoughts on private credit? How long will this cycle last?
I think private credit is not a generic term as well, and I think it depends on the allocators and what they see as private credit and what they want it to achieve. So insurance companies, I think they have very different needs than, say, public pension funds if they so allocate to that. So it's hard to say, but we haven't seen widespread distress yet, although I think there are opportunities to be had when that happens. So it also depends. I mean, there was a bit of a dislocation in 2020, which is very short-lived. People were looking at that, but I'm not sure if everyone managed to benefit from that. So it really depends on if it's kind of a base allocation or kind of opportunistic, for example.
Okay, so before I close off, just a couple of very short adverts. We have a alternative managers arcade, which is running in the room sort of over there behind, EDB room. We have a range of very interesting managers. Some of them are boutique, some of them are larger managers, speak about their outlooks and their strategies. So you will find that very interesting. So please sign up or just maybe go and register when you have a moment. And then also tomorrow, we have a panel that's going to be run by Dave Forsyth, who, which will cover hedge fund managers and alternative managers' perspective. That is tomorrow. Otherwise, thank you so much, guys, for a very interesting panel, engaging discussion. And let me pass it back to Feng Chao. Thank you.
Thanks, Jay. Thank you. Thank you, Deborah. Thank you, Wing Kwong, Michael, and Jay for the sharing.